Uh, This video is going to talk about how it is that a sound bank can fail. This is an important concept or idea to make sense of what happened during the Great Depression. Because during the Great Depression, about 9,000 banks failed in the United States. It was a huge part of what led to a decline in the money supply, a collapse of credit, and it certainly led to the depths of the Great Depression. It was also something that was relevant during the 2008 financial crisis and the Great Recession. So we're going to start with what we're talking about here is again the idea that a sound bank can fail. Well, what do we mean by a sound bank? Well, a sound bank would be one that actually has enough assets to cover their liabilities. So but it's like a bank that we have in the U.S. That uses fractional reserve banking, so we know they don't keep all of their money in the vault. They take that money and they lend a lot of it out, and they also invest in some other assets to earn returns by investing in the loans. Once they issue the loans, will count on their balance sheet as assets. But we don't want to get into too much detail about the bank balance sheet. So banks can lose money and then they would be unsound. So if a bank has made foolish investments and lost a bunch of money, then they can fail. But they'll fail because they no longer have assets greater than the liabilities, and that's when your liabilities are greater than assets, that's when a business or a banker is going to have to go bankrupt. So this is a bank that these would be banks that would be sound initially, but then they can end up failing. And they would fail through the mechanism of what's known as a bank run. A bank run is when depositors all wish to try to take their money out at about the same time. Why does a bank run start? Well, a bank run, because we have fractional reserve banking, and if the bank is unsound, if they've lost some value of their assets, then they don't have enough money to redeem all of the deposits if the depositors wanted to take them out. But if they're letting depositors take money out of the bank when they come in, if somebody comes in and says they want to close out their account, then as people take their money out of the bank, as long as the bank has money left, you can get your money out and you'll be safe. You'll be fine. But when the bank runs out of funds to be able to let people pull their money out, they'll have to stop doing so. And the people who haven't taken their money out yet, they would lose their deposits, because the bank, that would be in the case of an unsound bank, a bank that is in a bad financial position. And so that creates the logic of a run. You've got your money in the bank, and if the bank is in trouble, you want to get your money out of the bank before the bank runs out of money. Because if a bunch of depositors go to try to withdraw their money, the first ones in line can get their money out first. Now that leads to what's known then as a bank run. It's all the depositors try to take their money out. Now, and so it makes perfect sense if you're an individual depositor and you think there's any kind of danger of your bank failing, you would like to get your money out before the bank fails. So that makes sense from a depositor standpoint. Now, a bank run can start. It doesn't necessarily mean that a bank doesn't have to necessarily be in trouble for a bank run to start. All you have to do is have some depositors think the bank might be in trouble. You could hear a rumor, you could hear a story. Or back in the Great Depression, once banks started failing, if you live in a town and there's 3 banks and one of the banks failed, it's sort of almost inevitable. You're going to think, well, maybe that wasn't the bank that you had money in, but if one of the banks in town fails, you might be concerned that your bank could fail. And then if you hear again, you could hear some rumor or some report or whatever. A bank could have your bank could have could be okay, but they have a bad loan, and one bad loan isn't going to fail a bank. But you hear something about that, and now all of a sudden people start to think, well, your bank could be in trouble. And if you think the bank's in trouble, then you might want to just, even if they're sound, if you pull your money out, then you're safe. And if the bank survives, then you can put your money back in. So there's still this whole issue here. But the problem's going to end up happening with a run is that if you don't get your money out in time, then it's like musical chairs. You're going to be the person who's left without a chair at the end. The bank doesn't have money. They can't let you take your money out. and you can end up losing your deposits. You could lose your life savings when the bank fails. And many people, unfortunately, had that happen to them during the Great Depression. So that's the idea of a bank run. But the problem is, if the bank is sound, this fear that maybe the bank is unsound and then it faces a run could end up being a self-fulfilling prophecy. That people think a bank is in trouble, they start a run, and then it's the run that causes a sound bank to fail. And how would that happen? Well, like we said, banks take the deposits that they receive and they invest them. And they mostly through giving out loans, but then they also purchase some assets. So the banks have all of these assets, and the value of assets are determined by supply and demand. So this is just assume this is some assets that are held by the bank. Maybe it's like commercial real estate, maybe it's residential real estate, stocks, whatever you want. The bank is holding some assets, and initially we'll just put that their value here is 100. So if you look at the assets that the bank holds, when they're valued at this price, the value of their assets are such that the assets are greater than liabilities and the bank is sound. Well, assets, whether they be loans or real estate or whatever, assets are somewhat illiquid. And liquidity is is a term we use to refer to how easily you can convert some asset into its cash value. If an asset is difficult to convert into cash, it would be called illiquid. And the harder it is to convert an asset into cash, or another way of thinking of it, the longer it might take to sell an asset and get its fair market value, the less liquid or more illiquid that asset is. So the banks hold all kinds of assets, but they are quite illiquid. If banks are facing runs and they need to liquidate some of their assets, they want to convert some of those assets into cash so that they can have some money on hand to let people withdraw let depositors withdraw their money if they want. Well, if they have some money on hand and a few depositors come in, a run might be starting, and the depositors are able to get their money back, that could help defuse the run. I mean, people say, well, it doesn't seem like the bank's in trouble. They're letting people withdraw their money. So if the bank needs to try to liquidate these assets, sell them for cash so they can have cash on hand to give back redeem the deposits as the depositors come in and want to take them out. Well, what that would end up doing as banks, and not just one bank, but if a number of banks, which is what happened in the 1930s, a number of banks have to try to liquidate some of these assets at the same time, well, that's going to affect the supply curve in this market for assets. There'll be an increase in supply because if you're thinking about, like say, just the market for homes in a community, very few of those homes are actually offered for sale. The supply curve would be the homes that are offered for sale. Very few of those homes get offered for sale in a given year. If everybody tries to put their house on the market at the same time, that's going to be an increase in supply. So if you have a bunch of banks that now have to try to sell some of these assets that they're holding at the same time, that's going to shift the supply curve to the right. That's what's going to be happening here in this market for assets. There'll be an increase in supply as banks try to liquidate these assets and get cash because they need to hold more cash because of potential runs. Well, going back to chapter 3, we know anytime there's an increase in supply, there's the effect on equilibrium is a decrease in price and an increase in quantity. And we're not worried about the quantity here, but let's consider the price. If the price was 100 originally, it's going to go down, maybe to 70. When banks sell their assets at a price of 70 instead of 100, well, if they had them valued at 100, the price of 100, and the value of their assets were enough to cover their liabilities. But if you have to sell these assets at 70 instead of 100, then you've only got about 2/3 of the value that you had before. So before, assets were greater than liabilities, but if the value of your assets declined because of this price effect, then the value of your assets may well be less than liabilities, and that's what happens. And when that happens, that's when a bank fails. So that's how a run could be self-fulfilling, a self-fulfilling prophecy. A bank could be sound to begin with, but they try to liquidate assets to meet the run, and then by the time they liquidate their assets or have to sell them at what are known as fire sale prices, well, the value of their assets is no longer greater than their liabilities, and that means that the bank's going to be in trouble. There are several things that banks could do to address this problem of runs. Before the Federal Reserve was created in 1913, what banks did is they instituted something that's known as a suspension of payments. They stopped letting people take money out of the banking system. That they could still let people, write checks if businesses wanted to write checks to each other, as long as the money was going from one account to another. That's not leaving the system. So there was some limited bank operations, but people were limited in their ability to withdraw money from the system. And if you're talking about like in the 1800s or the early 1900s, we didn't have we didn't have ATMs, we didn't have electronic banking. People used cash for a lot of transactions. So suspension of payments could work to stop bank runs, but it was a painful thing, because when the local banks all had to put a suspension of payments on, is people couldn't go get cash, and so that was painful. And the thought was, well, maybe there's a better way to do this. And the Federal Reserve was created in 1913 in large part to serve as a lender of last resort. Because what you have here is, if you have a sound bank, and you know that they've got all these assets and they've got loans out there, and their loans are good, and they have got good assets, they haven't invested in assets that are not worth anything. If the bank has all of these assets, then and they're in a sound position, the Federal Reserve could loan money to the bank. They could loan money to banks so that they would have some cash on hand, so that they could handle depositors coming in and trying to withdraw their money. And if depositors can get their money back, then they don't have to. There's no incentive to start this run that could get out of control. So lender of last resort could work for this. The problem was that between 1930 and 33, when the 9,000 banks were failing, the Federal Reserve thought that the banks that were in trouble because they had made bad decisions. That they thought that the banks that were failing were unsound, that they had made bad investments, so they had invested in bad investments, bad loans, and that they were failing because their assets were less than their liabilities. And in some sense, they deserved to fail because they made bad decisions. And so the Federal Reserve didn't want to bail out banks that had made bad decisions. In retrospect, we know that, I think that economic historians know the vast majority of those 9,000 banks that failed were actually sound. So the Federal Reserve, in effect, was created in 1913 to try to do this thing of lender of last resort. They failed to do that. They failed to step in as a lender of last resort. There's another way we could solve this problem of bank runs, and that's how it's known as deposit insurance. And then that deposit insurance was created at the federal level in 1933. The Federal Deposit Insurance Corporation, FDIC, offers deposit insurance. Deposit insurance works like any other kinds of insurance. If you insure your automobile and you get in a wreck, your automobile is damaged, well, you get cash, you get money to equal to the value of the automobile. If you're a depositor and you've got $10,000 in the bank, and your bank has FDIC deposit insurance, then if the bank fails, then you get your $10,000 back. Well, not from the bank, because they don't have it, but you'll get it through the FDIC. You'll cash in your insurance policy and get that money back. And that can help diffuse a bank run as well, because there's no reason to go get in line and pull your money out of the bank if you're covered by deposit insurance. And if it turns out to be the case that a bank, that the bank that you have your money in turns out to be unsound and they end up failing, well, that's okay. The FDIC will give you your money. You'll get that money back, and you won't lose your life savings. And so deposit insurance has worked since 1933 to prevent a replay of what we saw between 1930 and 33 are all these thousands of banks failing. And again, failing because even though they were largely healthy at the start. Bank runs are a fascinating economic phenomenon. One of the things that makes it a lot of fun is as an economist to study the economy. It's a interesting and fascinating case of a self-fulfilling prophecy that we can see in the business world, and one that certainly in the 1930s ended up having a very, very bad effects on our economy.